Welcome to lecture number 32. This is our final lecture of the semester, and in lecture number 32, we'll briefly discuss the concept of capital budgeting. If you remember, we also did it when we were discussing the various types of budgets. At that time, we did the cash budget, and now we will look at the capital expenditure budget. We will also look at the concept of capital expenditure as to what does it mean. Planning for capital investments. Many companies, they must constantly determine how to invest their resources. इसकी एग्जांपल हो सकती है कि Dell announces plans to spend 1 billion on data centers for cloud computing. Now this is, an expenditure, or you can say that it is an investment which relates to your uh, capital expenses. Exxon announced that two wells of the Brazilian coast, which it had spent hundreds of millions of dollars, would produce no oil. So this statement tells us that uh, when you make a capital investment, or if you when you try to put capital expenditure into a business, not always does it have the positive output. Renault and Nissan spent over 5 billion during a nearly 20-year period to develop electric cars such as the Leaf. The process of making capital expenditure decisions is referred to as capital budgeting. Capital budgeting involves choosing among various capital projects to find the ones that will maximize a company's return on its financial investment. Now, what is capital expenditure? It is also called CapEx. Capital expenditures are funds used by a company to acquire, upgrade, and maintain physical assets such as property, plants, buildings, technology, or equipment. CapEx is often used to undertake new projects or investment by a company. Making capital expenditures on fixed assets can include repairing a roof, purchasing a piece of equipment, or building a new factory. This type of financial outlay is also made by companies to maintain or increase the scope of their operation. If you remember, when we talk, about uh, the value of any asset, so we always try to differentiate between the capital expenditure or the operational expenditure. Operational expenditure is also called OPEX, OPEX. It is also used to, use for day-to-day running of the asset. जो आपका कैपिटल एक्सपेंडिचर है, it normally adds to the value of the asset. For example, if you're trying to upgrade your asset, तो उसमें जो आपका एक्सपेंडिचर आएगा, उस एक्सपेंडिचर को आप एज कैपिटल एक्सपेंडिचर शो करेंगे, and that expenditure will increase the value of the asset. And then a asset ko how do you convert the cost of the asset into expenditure using the concept of depreciation. The capital budgeting evaluation. Many companies follow a carefully prescribed process in capital budgeting. At least once a year, top management requests proposals for projects from each department. A capital budgeting committee screens the proposal and submits its findings to the officers of the company. The officers, in turn, select the projects they believe to be most worthy of funding. They submit this list of projects to the board of directors. Ultimately, the directors approve the capital expenditure budget for the year. So, how is this process conducted? Project proposals are requested from the departments, plants, and authorized personnel. So, obviously, what sort of proposals are expected relating to capital expenditure? How can you increase the capacity of, let's say, your plants? What sort of new machinery should we be producing? So these are all capital expenditure decisions. उसके लिए you ask for proposals from your, departments, plant manager, and so on. फिर जो आपके proposals आते हैं, they are screened by a capital budget committee, और उसके बाद whatever shortlisting they do, the all officers determine which projects are worthy of funding. और ये जो आपके projects एक shortlist होते हैं, these projects go to the BOT and they approve the capital budget. The involvement of top management at the BOT in the process demonstrates the importance of capital budgeting decisions. These decisions often have a significant impact on a company's future profitability. In fact, poor capital budgeting decisions can cost a lot of money. Such decisions have even led to bankruptcy of some companies. Cash flow information. In this chapter, we will look at several methods that help companies make effective capital budgeting decisions. Most of these methods employ cash flow numbers rather than accrual accounting revenues and expenses. If you remember, हमने accrual accounting में पढ़ा है कि we recognize the revenue when it is earned rather than when it is received. तो हो सकता है बहुत सा revenue जो on paper आपका है, maybe a lot of it is in form of credit. तो जो in form of credit आपका revenue है, that does not have any effect on the cash pool that you have. जितना cash आपकी कंपनी में है वो इफेक्ट नहीं होता because of the accrual based revenue. और जो expenses आपके होते हैं जो cash based expenses होते हैं rather than accrual based, वो expenses जिसके लिए आपने payment कर दी है, those expenses are considered. Remember from your financial accounting course that accrual accounting records revenues and expenses rather than cash inflows and cash outflows. In fact, revenues and expenses measured during a period often differ significantly from their cash flow counterparts. Why? Because of the accrual basis. Accrual accounting has advantages over cash accounting in many contexts. For purpose of capital budgeting, though, estimated cash inflows and outflows are preferred inputs. इसका reason क्या है? Because ultimately the value of all financial investments is determined by the value of cash flows received and paid. Sometimes cash flow information is not available. In this case, companies can make adjustments to accrual accounting numbers to estimate cash outflow. Often they estimate net cash flow by adding back depreciation expense to net income. Now, why do you add depreciation expense to the net income? Because if you remember, आपका जो depreciation expense है, what it does, जो आपकी ऑलरेडी कॉस्ट आई थी कैश एसेट की, उसको इनिशियली एज आप एसेट लेते हैं एज अ करंट एसेट या जो आपका एज फिक्स एसेट होता है, देन यू कन्वर्ट दैट कॉस्ट इनटू एक्सपेंस थ्रू द depreciation expense. So remember, depreciation expense में there is no cash involved. तभी जो आपका depreciation expense होता है, you add it back to your net income. For example, the Reno company's net income of 13,000 उनकी total net income थी, includes a charge for depreciation expense of 26,000. So its estimated net cash annual cash flow would be 39,000. उसमें आप depreciation expense को add back कर देंगे. Illustration 24 lists some typical cash outflows and inflows related to equipment purchase and replacement. अब आपके cash outflows कौन से होते हैं related to any investment? वो आपकी initial investment हो जाएगी, फिर उससे related repairs and maintenance जो होगी, increased operating cost जो अगर आपके उस पर लग रही हैं और overhaul of equipment. ये आपके typical cash flows हैं related to capital budgeting decisions. Then we have the cash inflow. उसमें आपका आता है sale of old equipment, increased cash received from customers, reduced cash outflows related to operating costs, and salvage value of equipment. These cash flows are the inputs that are considered relevant in capital budgeting decisions. The capital budgeting decision under any technique depends in part on a variety of considerations. First one है availability of funds. Does the company have unlimited funds or will it have to ration capital investments? Basically, this availability of funds has a very significant effect on the capital budgeting decision that you will do. Then आपका relationships among proposed projects. Any proposed projects independent of each other, or does the acceptance or rejection of one depend on the acceptance or rejection of another? So we try to figure out what is the interrelationship between the proposals that have been submitted. Then you have the company's basic decision making approach. Does the company want to produce an accept or reject decision, or a ranking of desirability among possible projects? So it depends. Company जो है, how does it choose the capital expenditure decisions which have been submitted? The risk associated with the particular project. How certain are the projected returns? Certainty of estimates varies with such issues as markets and considerations or the length of time before returns are expected. For our initial discussion of quantitative capital budgeting techniques, we will use a continuing example which will enable us to compare the results of the various techniques. Acha, now this is the assumed data that we will be considering in order to study the capital budgeting. Assume that Stewart Shipping Company is considering an investment of 130,000 in new equipment. अब उनकी investment है 1,30,000. The new equipment is expected to last 10 years. It will have a zero salvage value at the end of its useful life. The annual cash inflows are जो आपकी annual cash inflow आएगा because of the capital investment वो 2 लाख का होगा, and the annual cash outflows होंगे वो 1,76,176,000 के होंगे. Illustration 24.3 summarizes these data. आपकी initial investment 130 की है, estimated useful life is 10 years, it has no residual or salvage value. तो आपके estimated annual cash flows हैं, cash inflow आपका 2 लाख है, cash outflow is 176,000. So जो आपकी net cash outflow है वो 24,000 का है. It means जो आपकी annually every year you will get a cash input of $24,000. In the following two sections, we will examine two popular techniques for evaluating capital investment, cash payback and the NPV method. Now, what is cash payback? It is the simplest form. Cash payback techniques identifies the time period required to recover the cost of the capital investment from the net annual cash flow produced by the investment. इसका फॉर्मूला क्या है? Cost of capital investment divided by net annual cash flow. It will give you the cash payback period. The cash payback period in the Stewart Shipping example is 5.42 years. How do we calculate it? हमें पता है जो आपका cost of capital investment है that is $130,000. We know कि annual cash inflow is $24,000. So the cash payback period is 5.42 years. इसका मतलब है कि it will take you 5.42 years to recover the total cost of capital investment which you made. So you made the cost of $130,000. So if every year you get cash inflow of $24,000, so it will take you 5.42 years to recover back your investment. So it is called cash payback technique. The evaluation of the payback period is often related to the expected useful life of the asset. For example, assume that Stewart Shipping is a project. Stewart Shipping a project is unacceptable if the payback period is longer than 60% of the asset's expected useful life. हमें पता है asset की useful life is 10 years. So 60% of the asset's expected useful life will be 6 years. So if the cash payback period is more than that, so the company will reject it. But as we have seen, it is 5.42 years. So according to the company's standard, this will be an acceptable cash expenditure investment. The 5.42-year period in this case is a bit low, over 50% of the project's expected useful life, thus the project is acceptable. It follows that when the payback technique is used to decide among alternative projects, the shorter the payback period, the more attractive the investment. This is true for two reasons. First, the earlier the investment is recovered, the sooner the company can use the cash fund for other purposes. Second, the risk of loss from obsolescence and changed economic conditions is less in a shorter payback period. अच्छा, अब इसमें एग्जांपल में आपने देखा होगा कि we are assuming कि जो आपका net cash inflow है that is constant, means it will be fixed for every year. But in reality, this not always is the truth. The preceding computation of cash payback period assumes equal net cash flows in each year of investment's life. In many cases, this assumption is not valid. In the case of uneven net um, annual cash flows, the company determines the cash payback period when the cumulative net cash flows from the investment equal the cost of investment. So we will look at an example. To illustrate, assume that Chen Company proposes an investment in a new website that is estimated to cost $3 lakh. The new website that the company wants to make, उसकी cost है $3 lakh. Illustration 24.5 shows the proposed investment cost, net annual cash flow, cumulative net cash flow, and the cash payback period. So आपकी total investment is 3 lakh. Net annual cash flow shows you the cash that will be coming in. So for we can see for each year it is different. So at the end of the third period, जो आपका cumulative net cash flow है, it is 240,000, और जो आपकी end of the fourth year है, it is 360,000. So you can see that 300,000 lies between 240,000 and 360,000. So the period, the total recovery period will lie between the third year and the fourth year. हम assume करते हैं कि जो आपका next year में 120,000 आ रहा है, that will be equal for each month. तो हम कहते हैं it will be 3.5 years. The cash payback technique may be useful as an initial screening tool. It may be the most critical factor in the capital budgeting decision for a company that desires a fast turnaround of its investment because of weak cash position. It also is relatively easy to compute and understand. So these are the advantages of the cash payback technique. However, cash payback should not ordinarily be the only basis for capital budgeting decision. Why? Because it ignores the expected profitability of the project. आप देखेंगे इसमें nowhere are we comparing the expected profitability of the projects. We are only trying to calculate the cash payback period जब आपकी total investment आपको वापस मिल जाएगी. To illustrate, assume that projects A and B have the same payback period, but project A's useful life is double the useful life of project B. Project A's earning power therefore is twice as long as project B's. If a further and major disadvantage of this technique is that it ignores the time value of money. What is the time value of money? Time value of money is that the money that you get today has more value than the money that you will get after 1 year. Why? Because of the interest that you can earn on that amount of money. Would you rather receive 1,000 today or a year from now? You should prefer to receive the 1,000 today because you can invest the 1,000 and earn interest on it. As a result, you will have more than 1,000 a year from now. What this example illustrates is the concept of time value of money. Everyone prefers to receive money today rather than the same amount in the future because of the interest factor. Now we'll do a small exercise question related to the cash payback period. Watertown Paper Corporation is considering adding another machine for the manufacture of corrugated cardboard. Machine की cost है 9,900,000, so that is your investment. It would have an estimated life of 6 years and no salvage value. The company estimates that annual cash uh, inflows would increase by 4 lakh. It means every year you will get a cash inflow of 400,000 because of this new machine, and the annual cash outflows would uh, increase by 190,000. So we have to compute the get cash payback period. Estimated cash inflows 4 lakh के हैं, outflows are 190,000. So जो आपकी net annual cash flow है, that is 200,000 positive. It means every year you will get $200,000 into the business because of the machine that you are intending to purchase. तो आपका cash payback period होगा आपकी total investment divided by net cash annual cash flow. So it is 4.3 years. So it will take you 4.3 years to recover the investment of 900,000 that you will put into buying this machine. The second one is net present value. Recognition of the time value of money can make a significant difference in the long-term impact of the capital budgeting decision. For example, cash flows that occur early in the life of an investment will be worth more than those that occur later because of the time value of money, जैसे भी हमने पढ़ा है. Therefore, it is useful to recognize the timing of cash flows when evaluating projects. Capital budget techniques that take into account both the time value of money and the estimated net cash flow from an investment are called, these methods are called discounted cash flow techniques. They are generally recognized as the most informative and best conceptual approaches to making capital budgeting decisions. The expected net cash flow using discounting cash flows consists of the annual net cash flow plus the estimated liquidation proceeds of the salvage value is sold or salvage at the end of its useful life. The primary discounted cash flow technique is the NPV method, net present value method. A second method is the internal rate of return, which is called IRR. So this is the end of lecture number 33.